trying to enthuse the mission of Bitcoin adoption and why it's important for your portfolio in your 60-40 allocation. A lot of investors will say, if I just put like 1 to 3%, then I guess that's the right size. And we ask them like, well, why would that be the right size? And what you hear often is that's the size in which if it goes to 0, it doesn't matter. And if it goes up 10x, it will be an important driver of my return overall. These people are already thinking about allocating to an asset where it can go to 0. And they're thinking about it as a premium outlay. Well, let me tell you, if you're only going to put 3% of your notional into Bitcoin, I can guarantee you'll get much more leverage for that cash outlay if you use options. And I think many people will still continue to express their views this way because they're still very concerned about the asymmetry of Bitcoin's total return profile. So when dealers are long gamma, it's actually creating mean reversion. When dealers are short gamma, it creates momentum. And so this is the thing that I think a lot of people are aware of. There's not enough today to see exactly how large those gamma pins will become over time, but I suspect that a lot of the interest will continue to build there. You already saw that happen on day 1 of this going live.
Bitcoin's volatility isn't just unpredictable, it's rewriting market rules. Discover the hidden mechanics fueling Bitcoin's meteoric movements and why its unique dynamics could redefine trading strategies forever.
But I continue to believe that a lot of the folks are interested in finding ways to build leverage into their positioning of Bitcoin that is more capital efficient. Here's the reason. When I am at front of clients at Bitwise, and I do this every day, trying to enthuse the mission of Bitcoin adoption and why it's important for your portfolio in your 60-40 allocation, a lot of investors will say, if I just put like 1 to 3%, then I guess that's the right size. And we ask them like, well, why would that be the right size? And what you hear often is that's the size in which if it goes to 0, it doesn't matter. And if it goes up 10x, it will be an important driver of my return overall. These people are already thinking about allocating to an asset where it can go to 0. And they're thinking about it as a premium outlay. Well, let me tell you, if you're only going to put 3% of your notional into Bitcoin, I can guarantee you'll get much more leverage for that cash outlay if you use options. And I think many people will still continue to express their views this way because they're still very concerned about the asymmetry of Bitcoin's total return profile. I think that there is a lot of room for vol to still go up, and it's because when you look at the volatility cone of even the last year, we're maybe about below 75 percentile, slightly above the median. The last time I checked on Deribit's vol distribution, and the max was somewhere around 85 in the past year. So there's room to grow. This isn't like MicroStrategy, for example, where we're about to hit 200 implied vol today. We're very close to it. That will be an all-time high. And I would say there, the risk is a little bit more asymmetric to the downside of it coming in. On the relationship between Deribit vol and IBIT vol, I think that there is something really interesting, which is if you think about Deribit, it's a crypto native exchange, right? And so you can trade those options anytime, whereas IBIT options you can't. Those are 9:30 to 4 p.m. instruments. So that means that Deribit options technically have a much longer shelf life for gamma monetization than the IBIT options will let you. Fundamentally, they shouldn't actually be treated the same way. It's almost like, let's imagine security A was Bitcoin between 9:30 and 4, and security B was Bitcoin between 4 p.m. and 9:30 a.m. And they're different beasts, right? They're different. They have their own trading pattern. And Deribit is the option that gives you A and B. IBIT gives you A. And so what does that mean, practically speaking? It means that if you believe that Black-Scholes is based off of the implied volatility being the clearing input for a delta hedging replication portfolio, you get almost half the more time to monetize that gamma with Deribit options than you will with IBIT. If you looked at the close to close vol of futures, there was a day when it looked like maybe Bitcoin moved like 30 bips. But if you measured all of the intra-day highs and lows throughout and actually annualize that number, it was 800% vol. So if you could trade the gamma for those hours that you couldn't with an IBIT option, then technically that's free data. You could make money leaning onto those exposure in a way that you couldn't have before. forward. There are ways in which you still would imagine there should be one volatility surface for one contract. But now I'm going to say there's going to be somebody who's going to trade the IBIT options, but they're going to trade the underlying Bitcoin spot 24/7. If you can do that, you are the person that's outside the perfect arbitrage pricing model that can do different things. So this is why I continue to believe that crypto native derivatives traders are going to make more money than those who have to be in one system or the other, because you are able to live in both worlds and do things that Millennium, for example, couldn't do. And Millennium is most likely going to be the price setter for the IBIT vol surface because they're the heaviest consumers most likely in the traditional system. But if you can lean on that and trade Bitcoin throughout the weekends, through Saturday and Sunday and overnight, then you got yourself some free gamma. I think this is an incredible phenomenon where this moment in time for Bitcoin ETF options to exist, it's really historic, because to me, it's ultimately Wall Street's answer to, if you can't beat them, join them. It's that moment. Goldman, you might have seen, is now spinning out their digital assets team. Who knows what that's all going to be about? I think it has to do more with the distributed ledger technology instead of trading. But if you think about kind of the interest in TradFi, this really is a seismic shift that signals Bitcoin's not anymore this outside system asset. It's a cornerstone of like our modern markets, and it's now blending the line between traditional finance and crypto. And so for someone like me who approached crypto with a financialization interest as well as a technological interest, it's giving us a new era of legitimacy, levered legitimacy, if you will, into the future construct of money and the money velocity.
Jeff Park delves into the unparalleled volatility of Bitcoin, highlighting a groundbreaking anomaly. Its price often defies standard market correlations. For traditional assets, a market dip typically spikes volatility. Yet Bitcoin has shown days where prices drop and volatility plummets alongside, defying expectations. Conversely, Bitcoin's steady climbs can spark erratic volatility shifts, presenting traders with unprecedented opportunities to exploit gamma and vega dynamics. Additionally, Bitcoin's volatility smile suggests melt-ups are as likely as meltdowns, an attribute rare in financial instruments. Park emphasizes the retail and institutional demand behind Bitcoin's options, revealing a staggering skew favoring calls over puts. This positioning signals optimism for Bitcoin's upside, laying the groundwork for explosive price discovery through phenomena like gamma squeezes.
The most important thing is to understand how dealers are positioned towards whether they're naturally short or long these options. And you will never have perfect clarity into their exact positioning as to whether they're longs or shorts of the open interest, but you can generally tell. And the reason is, most of the times with upside, as is seen in almost every asset, people buy long vol to speculate. You don't see the dealers necessarily doing that, especially super long dated, unless it's coming from the back of like a principal protected buffered note type of transaction, the structured products business, which I think will arrive, but it hasn't yet. So knowing that it hasn't arrived yet, we can almost certainly know all the people that bought those IBIT long dated out of the money leaps are retail or institutional investors who want to take that directional risk. That there are certain open interests where there's going to be what is called a gamma squeeze. The gamma squeeze is a very, I think now well-known phenomenon. Once upon a time, it was a little bit of an esoteric corner of derivatives market, but I think GameStop put it on the map for everybody. But I'll just give the quick 30-second overview. The concept of a squeeze, a gamma squeeze, is that the dealers who are naturally short those vol exposure, to hedge it will actually end up exacerbating the price movement as a result of their hedging portfolio. So if you're short calls, you have to buy stock to hedge. As you go up, you get shorter and shorter delta, so you got to buy more to keep hedging. Well, now you're buying into strength. That's called a gamma squeeze, because you're literally the person that is contributing to furthering the movement of the price that is recursively now making you buy. That's not the case when gamma is long by dealers. When gamma is long by dealers, their hedging transaction is the reverse, right? So if I'm long a call as the dealer and I'm short the stock and the stock is going up, so my delta is increasing, then my hedging portfolio is to sell the stock. So when dealers are long gamma, it's actually creating mean reversion. When dealers are short gamma, it creates momentum. And so this is the thing that I think a lot of people are aware of. There's not enough today to see exactly how large those gamma pins will become over time, but I suspect that a lot of the interest will continue to build there. You already saw that happen on day one of this going live. And so what this ultimately means is that the gamma squeezes are more likely going to be observable by all market participants, and so they're going to be able to think about those types of air pockets. Now we have to talk about Bitcoin and the unique nature of why this is even more of a phenomenon for Bitcoin, which is, we just talked about this, the skew. For Bitcoin, because it can melt up just as much as it melts down, when it goes up a lot in price, the vol actually goes up. You saw that with MicroStrategy. The fact that MicroStrategy is higher and now the implied vol is the highest it's ever been, while it's had a consecutive run that's now over 50% this week alone, shows you the incredible correlation that is not typical of most assets in the securities world. And so if vol goes higher, the input of that to Black-Scholes means the delta also goes higher. So there's this hidden second order Greek, and that's called Havana, which is that mark to market, you won't see it throughout the day, but once you reprice the options, your delta will have jumped because your vol moved with you. And it was not a static number you assumed at the beginning of the day. So it means you're underhedged and now you have to overhedge the next day. And this is actually a pretty recursive thing, and why I call it like adding fuel to the rocket that was already going to take off at an extraordinary level. And this is the most powerful thing, in my opinion, that will accelerate the discovery of Bitcoin's price in the future. All it's doing is it's accelerating the velocity of Bitcoin's price discovery by being able to use leverage in a way that the system has not seen it before. The nature of leverage allows you to synthetically create more risk and exposure that isn't one-to-one collateralized, right? This is why it is accelerating, in my opinion, the velocity rather than actually the creation of the state money, because there is an offsetting side to every one of these financial transactions. Whenever you create a derivative where you're long, there is a short against it. It's not just one direction. Can there be momentary glitches in ways where clearing can be an issue, where the financial infrastructure and its plumbing may not properly account for some of these notionals? Rare, but it's possible. Like, this is actually a risk that I think we generally have in the financial system, which is why we have the OCC at the center and having them needed to sign off on the launch of these ETF options. It is still possible today, even though you're not allowed to short stocks naked, that it could happen, right? Reg Show was put in place, so you're not permitted to do it. It's illegal, but it's not, doesn't mean that it doesn't happen, right? Sometimes it could happen. You know, that being said, for Bitcoin ETFs, it's been very clean. I have not seen actually any real material issues over the last 6 months.
Bitcoin's volatility isn't chaos. It's a system ripe with opportunity for those who understand it. As Jeff Park reveals, gamma squeezes, call skew imbalances, and a volatility smile unique to Bitcoin are driving forces behind its transformative potential. These dynamics hold clues to future market dominance. Stay ahead of the curve and prepare for the seismic shifts that could redefine how the world views financial assets.